What if I told you that two of the most popular income ETFs on the market right now have a performance gap so wide it could mean the difference between a Caribbean vacation and a weekend at a Holiday Inn? I put $10,000 into SVOL and $10,000 into JEPI, tracked them both for 12 months straight, and the results genuinely shocked me. One fund nearly doubled the returns of the other while somehow managing to take less risk. Not slightly less, dramatically less. Stick around because by the end of this video, you'll know exactly which one deserves your hard-earned money and which one might be quietly robbing you of returns you didn't even know you were missing. Let's set the stage. If you're anywhere in the income investing world, you've definitely heard of JEPI. The JPMorgan Equity Premium Income ETF is the golden child of dividend funds. Over $39 billion in assets under management. That makes it the single largest actively managed ETF on the entire market. Everybody and their financial advisor loves this thing. Reddit investors swear by it. It shows up in every best income ETF list you'll ever find online. And for good reason. JEPI delivers consistent monthly income with lower volatility than the S&P 500 and a yield sitting around 8.5%. It became a household name after the 2022 bear market, where it held up beautifully while both stocks and bonds were falling apart. In a year where the S&P 500 dropped over 20% and bonds offered zero shelter, JEPI was one of the few genuine bright spots in people's portfolios. But then there's the underdog. SVOL, the Simplify Volatility Premium ETF. Way fewer people talk about it. Way fewer people own it. It's sitting at around $600 million in assets compared to JEPI's nearly $40 billion. David versus Goliath doesn't even begin to describe this matchup. But when I ran the numbers side by side over 12 months, SVOL didn't just beat JEPI. It absolutely destroyed it. A 19.79% annualized return from SVOL versus JEPI's 10.73%. That is not a small edge. That is a canyon. But here's what separates a smart investor from a reckless one. Before you rush out and dump everything into the higher number, you need to understand why these two funds perform so differently. Because the engine under the hood matters way more than the number flashing on the screen. And that's where things get really fascinating. Let's break down how JEPI actually puts money in your pocket. JEPI runs a two-pronged strategy. First, it builds a portfolio of low-volatility, defensive large-cap U.S. stocks. Think household names, blue-chip companies that don't whip around wildly when the market gets jittery. The kind of stocks your grandparents would approve of: stable, boring, reliable. The portfolio holds over 130 hand-picked names across diversified sectors, with tech exposure capped near 20% to avoid the dangerous concentration risk that plagues the top of the S&P 500 right now. But here's the problem with low volatility stocks. They don't generate much in options premiums on their own. So JEPI does something genuinely clever. It uses financial instruments called equity-linked notes, or ELNs. These are structured products issued by major global banks that replicate the payoff of selling 1 month out-of-the-money covered call options on the S&P 500 index itself. JEPI can invest up to 20% of its portfolio in these ELNs. Now, ELNs do carry counterparty risk since you're relying on the issuing bank to honor the contract, but JPMorgan diversifies across multiple global financial institutions and monitors that risk carefully. So think about what's happening here. JEPI isn't writing covered calls against its own stocks. It's writing them against the broader index through these ELN instruments. It targets about 30 delta out-of-the-money calls and rolls them in weekly tranches. That rolling approach reduces something called path dependency, which in plain English means it doesn't bet everything on a single expiration date. Instead of one big monthly bet, it spreads risk across multiple weekly expirations. Clever design. The result is you get the downside cushion of a low volatility stock portfolio, combined with the richer premium income from writing options on the more volatile S&P 500 index. But there is a clear trade-off. This strategy caps your upside significantly. When the market rips higher, JEPI investors watch the gains fly by from the sideline because those call options generating your income now limit how much you can participate in the rally. Now hold that thought because the challenger plays a completely different game. SVOL doesn't mess around with stocks at all. Instead, it goes straight to the source of market fear itself, the VIX. If you're not familiar, the VIX is the market's fear gauge. It measures expected volatility in the S&P 500 over the next 30 days. And here's a fact most people don't know. The VIX futures market has a structural quirk that smart money has exploited for decades. About 80% of the time, VIX futures trade in what's called contango. That means future contracts are priced higher than the current VIX level. Over time, those expensive futures contracts roll down to meet reality. And if you're short those futures, that roll down puts money directly into your pocket. It's like gravity for volatility, and SVOL is specifically designed to harvest that gravity every single day. SVOL shorts VIX futures at about 20 to 30% of its total portfolio exposure. Now I know what you're thinking. Shorting volatility? Isn't that how people blow up their accounts? And yes, several funds have completely imploded doing exactly that. Remember the 14th disaster in 2018? Billions of dollars evaporated literally overnight. But SVOL has a critical difference that changes the entire equation. A built-in safety net, SVOL simultaneously buys deep out-of-the-money VIX call options as protective insurance against extreme volatility spikes. The fund allocates about 2 to 4% of its budget toward these protective hedges every quarter. Think of it like driving a sports car, but always wearing your seatbelt with full airbags. You get the speed, but you've got serious protection when things go sideways. The rest of SVOL's portfolio sits in treasury bills and short-term fixed income securities, which generate additional yield from the cash collateral. So you've got 3 income engines running simultaneously: the VIX futures short premium, the treasury yield, and the options overlay. That triple threat is what powers SVOL's distribution yield, which has hovered around 15 to 20% depending on market conditions. Recently, it's been paying about 30 cents per share every month on a roughly $17 stock price. Run that math, and your jaw might drop. Okay, now here's the part you've been waiting for: the actual head-to-head results. And honestly, these numbers are wild. Over the 12-month testing period, $10,000 invested in SVOL grew to $13,111. That same $10,000 in JEPI only reached $11,652, nearly $1,500 more from SVOL on the exact same starting investment. Scale that to a $100,000 portfolio, and you're looking at almost $15,000 sitting on the table that JEPI investors never touched. That's a used car. That's a family vacation. That's real money with real impact. But raw returns are only half the story. What truly separates these two funds is risk-adjusted performance. This is where SVOL doesn't just win. It runs away with the entire trophy case. SVOL posted a sharp ratio of 1.88 compared to JEPI's 0.71. For anyone who doesn't speak Wall Street, the Sharpe ratio measures how much return you get for every unit of risk you take on. A Sharpe above 1.0 is considered good. Above 1.5 is excellent. SVOL nearly hit 2.0, delivering almost triple the risk-adjusted returns JEPI generated, triple. Let that number sink in for a second. The Sortino ratio, which specifically isolates downside risk, SVOL came in at an insane 5.99 versus JEPI's solid but unremarkable 1.09. SVOL was exponentially better at protecting your money from losses while still delivering those massive returns. Now here's the stat that genuinely surprised me most: maximum drawdown. During the entire testing period, SVOL's deepest dip was just negative 1.47%. JEPI's worst drawdown? Negative 4.11%. So SVOL returned nearly double the gains while experiencing less than half the maximum loss. In investing, that almost never happens. Higher returns almost always come with higher risk. This result broke the mold entirely. So if SVOL is this incredible, why doesn't every income investor just buy it? Here's the honest truth. SVOL is significantly more complex, more volatile on a day-to-day basis, and carries risks that most casual investors simply don't understand well enough. SVOL's overall price volatility measures 10.59% compared to JEPI's buttersmooth 1.86%. On any random Tuesday, SVOL's price can swing roughly 5 times more than JEPI's. If you're the type of person who checks their brokerage app every morning and feels their stomach drop when they see red numbers, SVOL might give you a panic attack, even though it's actually making you wealthier over time. Investing is a psychological game as much as a financial one, and that daily volatility matters more than most people will ever admit. Then there's the expense ratio. SVOL charges 0.50% annually versus JEPI's 0.35%. Over decades, that 15 basis point gap compounds into real money. Though at these return differentials, it's barely a rounding error. And then the elephant in the room, NAV erosion. SVOL's strategy inherently involves gradual degradation of the fund's net asset value. The share price drifts downward over time even as those fat monthly distributions keep flowing into your account. Here's the critical insight most people miss. If you reinvest roughly 50% of SVOL's dividends back into the fund, you can maintain your original principal and still capture about 8% in spendable annual yield. That's competitive with JEPI on income, while delivering significantly better total returns. But you have to actually do the reinvestment consistently. Spend every single dividend check and your capital base slowly melts beneath you. JEPI doesn't have this issue. Its NAV has remained far more stable because the ELN covered call strategy doesn't inherently drain fund value the same way. For retirees who absolutely need to spend every dollar of income without touching their principal, this distinction matters enormously. It might be the single most important factor in making your decision. So let's answer the real question. Who should actually own what? SVOL is purpose-built for the tactical investor who understands volatility markets, isn't intimidated by complexity, and has the discipline to reinvest a portion of those fat monthly checks. If you're building a high-income satellite position within a diversified portfolio, SVOL is a powerful tool. It thrives when VIX futures are in contango, which historically happens about 80% of the time. That structural tailwind is SVOL's secret weapon and single biggest edge. JEPI is the sleep-at-night choice. Managed by JPMorgan, the largest bank in America. Battle-tested through the brutal 2022 bear market, where it cushioned investors while the S&P 500 dropped over 20% and bonds provided zero relief. If you want reliable monthly income, predictable behavior, and the comfort of $39 billion of investor confidence backing your thesis, JEPI is your fund. It won't make you rich overnight, but it won't keep you awake at 3 in the morning wondering what the VIX futures curve did while you were sleeping. Here's what fascinated me most about this entire experiment. Conventional wisdom says you must choose between high yield and safety. You get one or the other, never both. What SVOL demonstrated during these 12 months is that sometimes the unconventional play, the one that makes traditional analysts and Wall Street academics nervous, actually delivers superior returns with genuinely less drawdown risk. A 19.79% CAGR paired with a 1.47% max drawdown is the kind of result that makes seasoned portfolio managers spill their morning coffee. But past performance is never guaranteed. SVOL launched in May 2021 and hasn't endured a prolonged systemic crisis like 2008. The VIX spiked to 60 briefly in early 2025 during tariff-driven market panic, and SVOL's protective options worked exactly as designed. But a sustained multi-month high volatility regime could stress this strategy in ways we simply haven't witnessed yet. JEPI's proven 2022 bear market track record earns a type of credibility that no backtest or spreadsheet can ever replicate. My final verdict? For a long-term retirement hold, I'd lean JEPI for its simplicity, institutional backing, and proven battle-tested resilience. But for a tactical allocation of 10 to 20% of your income sleeve, SVOL's risk-reward profile was genuinely hard to argue against. Now here's the million-dollar question, and I actually want your answer. Would you rather take the higher return with more complexity, or the steadier ride with more predictable gains? Because how you answer that question reveals more about your investing DNA than any financial textbook or YouTube video ever could. Drop your pick in the comments right now, SVOL or JEPI, and tell me why. I read every single comment on this channel, and I'll pin the most interesting take at the top. If this video opened your eyes to something new about income investing, smash that like button. Share it with a friend who's chasing dividends in all the wrong places. And if you're not subscribed yet, hit that button and turn on notifications, because next week we're comparing two more income ETFs that nobody is talking about yet. And the results are even more surprising than what you just watched. Trust me, you do not want to miss that one.